Good afternoon and welcome to NYFP. In midday trade on this Friday ahead of the long holiday weekend, U.S. stocks are in the red. Joining me now is Peter Cardillo of Rockwell Global Capital. Peter, good afternoon and thanks for joining me.
My pleasure to be back.
Well, as we head into the holiday weekend, we are seeing downside pressure for the equity averages. Durable goods orders came in better than expected, but we saw downward revisions for the previous month. And given that we had those Fed minutes and Bernanke's testimony, what do you expect to see in the near term?
Well, I think, next week is going to be an abbreviated week, and we have a lot of economic data. So until we get, the data convincing the market that the Fed is not going to trim the QE program anytime soon, I think we'll probably stay within a consolidation phase around these levels. I don't expect the market to move much lower. Worst case scenario, we're in a little slightly mild pullback, which I think is going to be short-lived. So, in an abbreviated session next week, the possibility that we move sideways and digest the economic data is a likable scenario.
And Peter, I do want to get your take on the division we're seeing in the Federal Reserve. Now, those FOMC minutes showed the division, but what do you make of that, and what did you glean from Bernanke's comments?
Well, let's talk a little bit about Bernanke. I mean, Mr. Bernanke said nothing new. He's been saying this all along, that everything is data dependent, and so until we see a real turnaround in unemployment, until we see the economy really pick up steam, let's say grow closer to 3% as opposed to 2%, then I think the chances of them trimming is not going to happen. And he's been consistent with that. Now, as far as the FOMC minutes are concerned, no question that, we're seeing this division among Fed members grow, and there were some who advocated that they probably would like to have seen the bond buying program trimmed by as early as next month. And so that caused this divergence between the what Mr. Bernanke said and the Feds. And to be quite frank with you, what happened was simply this. The market was looking for an excuse. It was at record levels. It needed to pull back somewhat, and they found that perfect excuse, which was the Fed minutes. And so I think it's safe to say that the market's reaction of dropping substantially and then reversing the very next day is a good indication that this bull has long legs and is not going to die that easy.
And indeed, in midweek trade, we saw plenty of volatility. When Bernanke began speaking, we saw the S&P 500 hit new record highs, but we're here on this Friday, and we're seeing that index down by over 2.5% since we reached those record highs. So heading into next week, you mentioned that we'll be keeping an eye on data, but what can we expect from the U.S. GDP?
Well, the final revision of Q1 GDP, probably looking at a flat number from the previous reading, which is 2.5%. In terms of other economic data, I think, we have housing, we have consumers' confidence, we have consumer sentiment, but I think the two key numbers next week will probably be personal income and spending, which we're probably looking at modest gains. So, again, looking at modest growth.
Okay, Peter, well, thank you so much for joining me on this Friday, and have a great holiday weekend.
Thank you.